There's a little known secret to saving massive amounts of money on your taxes. I'm going to share it with you today because Grant Cardone talks about it, but he forgets to mention one key element.
Hey, you guys that are earning $2 million a year, $1 million, $2 million, $3 million, $5 million, ball players, rappers, big earners, show you a little trick to the wealthy note.
The title of his video is How Big Earners Reduce Their Taxes to Zero, which is obviously aimed at those who are earning a lot of money, but this video will hopefully be helpful to those at any income level.
If you got a talent or you got a business, your biggest expense is number one, your taxes.
He's right, a six-figure earner in California, New York, and any other state with state income taxes will likely be paying $40,000 or more per year just in taxes.
What the wealthy know is how to reduce their tax bill. That's what you don't know that you got to get a handle on. Reduce your tax bill.
What I found to be the response in this conversation is you have two people. One person will be mad at the wealthy and upset at the idea that someone who earns a lot of money is pursuing a legal way of reducing their tax burden. The other person will watch these videos as motivation to learn how to replicate in order to further their income and wealth. Both people are going to be right in their assessment, so it's on you to choose which person you'd like to be.
So if you're earning $2 million a year, we're going to take that down to zero.
What he talks about in this video is helpful for big earners, but I think it's even more helpful for people earning much less. You'll see why in just a minute.
So let's say you're earning $2 million a year. If you live in New York City, $1 million of that is going to the IRS.
I think you'll be just fine in life if you're making $1 million a year, but this video is aimed at athletes and entertainers who notoriously have short careers.
And if you're a ball player, out of that came 200 grand for an agent, another 200 grand probably for a manager, and you're having to live on 800,000.
I've made a lot of popular videos on why your favorite athletes go broke, which highlights why the number you see them making ends up being a lot less in their pocket. Athletes and entertainers in 2022 are making so much money that it's significantly harder for them to go broke now as opposed to 20 years ago, but it still happens. Reckless spending, taxes, and not investing can decimate anyone.
You earn $2 million, okay? Live on as little of this money as you can in the beginning. Do not spend earned income.
There's news reports that Rob Gronkowski never spent his NFL money and only lived on endorsement money. I'm pretty sure Marshawn Lynch is another example. Living frugally at the beginning of any career is a cheat code and one I've utilized to grow my net worth substantially over the past few years. This is $10,000 invested once with no additional contributions in the future, making 7% every year. In 30 years, it'll be $76,000. Just picture every $10,000 you can save today is worth $76,000 or more when you reach your retirement age. Even just a couple years in your youth living frugally with roommates will lead to massive net worth gains over your lifetime.
You got $1.6 million. I want you to invest as much of that $1.6 million into real property. Real property will buy you about $4.8 million worth of, in this case, real estate.
Here's where I start to disagree with Grant, mostly because he leaves a lot of details missing. He says that athletes can spend their after agent and manager money on real estate, which is false. Athletes are W-2 employees of the organization they play for. W-2 employees in almost all scenarios pay taxes first and don't have any ability to utilize real estate to reduce their tax burden.
$4.8 million, for instance, in a deal that I'm doing right now, will provide you with $2.4 million worth of depreciation.
Depreciation expense is the biggest cheat code in reducing your tax burden, and I want to show you why. I made a video recently giving people an idea on how to make crazy returns in real estate with depreciation being the secret. When you buy an investment property, you're buying both the land and the building. The building can be depreciated over a certain length of time, resulting in a line item expense for depreciation. Grant's example is a $4.8 million property with depreciation of $2.4 million. With standard depreciation, you won't have a number this big, but you can with something called bonus depreciation. Bonus depreciation allows a taxpayer to deduct 100% of depreciation upfront on their federal tax return. I'm not a tax expert, so speak with yours if you need the details, but it's essentially depreciating the building's entire lifespan into this year. In this video, we're talking about how to make money, but we also need to talk about how to protect your money, which is why I went with today's sponsor, Ridge Wallets. I don't know about you guys, but I am sick of having big, bulky wallets that are not only uncomfortable in your pocket, but also look beat up and worn when you pull them out. Not only that, but I have to frequently replace them because of how ugly and weathered the leather gets. Well, thankfully today's sponsor Ridge sent me one of their wallets to solve all of those problems at once. I've been using the wallet Ridge sent me, and it's amazing how simple it is to use and how easy it fits in your pocket. Ridge wallets are forever wallets. They're the most sleek and durable wallet out there. And with how sleek they are, I was surprised to find out that they can hold up to 12 cards at one time. And why would I have all my keys poking and prodding my thighs when Ridge offers a durable and foldable key case that holds up to 6 keys at a time? The Ridge team is so confident that you'll like their products that they'll let you try it out for 45 days. And if you don't absolutely love it, you can send it back for a full refund. So get the best offer with the link ridge.com/Spencer. It's an awesome product that I've been using for the last month as my everyday wallet. I'm glad I switched. And if you want to make the switch, go to ridge.com/Spencer or use my link down below. Back to the video. To give you a rough example, this multifamily in LA is listed at $4.75 million, with the building worth a little over $4 million. This building would normally depreciate somewhere around 150 grand a year for 27 and a half years. With bonus depreciation, you'd be able to depreciate the entire lifetime of the building in this year. The write-off will be in the millions.
That reduces this tax bill of 1.6 after your managers, these are expenses, to negative $800,000.
What Grant is attempting to show is that a professional athlete or entertainer earning $2 million can buy a piece of real estate and have an $800,000 loss in their taxes. This isn't exactly accurate, which I'll share why in a minute. First, in order to utilize bonus depreciation, you need to hire an expert to perform a cost segregation study. These are inexpensive and lead to a report on how much you can depreciate your building on the first year of operation.
Earned income needs to be zero, and passive income.
Since athletes are W-2 employees, getting your earned income down to zero is basically impossible, so what Grant is explaining isn't applicable. If you want to understand this concept further, I'd recommend watching this video by Carlton Dennis titled How to Use Real Estate to Avoid W-2 Taxes. He explains the concept of active income, and passive losses really well.
Take the 1.6, leverage it, it'll buy $4.8 million worth of real property.
The problem is that Grant misses the fact that those athletes and entertainers are still going to owe tax money on the $1.6 million of earned income. The depreciation expense will give them massive passive losses for the year, which can be carried forward to future years, so it would help offset rental income for a decade, but it wouldn't offset their earned income today.
You would invest and leverage 3 to 4 times, buy $4.8 million worth of real estate that would give you $2.4 million worth of depreciation. In the first year, it's a little complicated now. This is called accelerated depreciation. But this is the game. This is the game that the wealthy know how to use.
The reason why I'm making this video is that he's missing one element, that the athletes would need to be real estate professionals in order to offset their earned income with passive losses from their real estate. But I'm going to provide a solution. Athletes have off seasons. In the off season, the athlete can get their real estate license and commit time to real estate activities in order to meet the requirements of being a real estate professional. In Grant's example of someone earning $2 million, let's assume they'll pay $600,000 in taxes. By becoming a real estate professional and investing in a $4.8 million property, they'd immediately earn $600,000 from being a real estate agent in the form of tax savings.
This $1.6 million that you invested should provide you with about $90,000 a year in income. Passive income.
Investing in real estate is the easiest way of getting wealthy in America that I've seen. Massive tax advantages if you claim real estate professional, cash flow, and appreciation.
But in year 2, you now have $9.6 million worth of real estate, real property that should be appreciating in value.
All it takes is a couple years of being a super high earner and investing in real estate to be set for life. Every professional athlete should retire with a $10 million real estate portfolio, earning $50,000 a year in cash flow at a minimum. Grant's video has 1.9 million views, so it's been seen by a lot of people trying to get into the real estate game. I wish he would have discussed the real estate professional status, as it is the key element to making his strategy work. What my wealthy real estate friends do is buy just enough real estate every year to offset their earned income because they cost seg and bonus depreciate every property they buy. You own an asset that is appreciating, and in the first year you buy it, you can depreciate the building to offset your income and pay $0 in taxes. It's a completely legal and valid strategy. In Carlton's video, he explains how to offset W-2 taxes by buying rental properties that are short-term rentals. This is something I didn't know, and I'd recommend watching his video if you want to learn about this concept more deeply. I'm a real estate agent. I run a real estate meetup in Vegas. I manage my rental properties. I have a short-term rental. I'm not wealthy yet, but I'm on the right path because I've been fortunate to learn from those who share all of the secrets. Grant certainly has his flaws, but he gives away a lot of valuable investing information if you know where to look. He discussed the recent allegations of him front-running on my buddy Ryan Pineda's podcast and how it wouldn't be possible to do with commercial bank loans. I'd recommend watching the episode if you want to understand his position and listen to his response. Grant has always been one of the most requested people on my channel, but I refuse to make videos on speculation. I'm rooting for Grant to succeed because that would mean his investors are happy, and he's got like 10,000 of them. If Grant fails, then all of those same investors lose money. I don't want that. Thanks for watching.